Hello, good morning. Welcome back to another pre-FTMO Forex trading class. And today we shall pick up from where we left on Monday. So our topic will still be on market structure. And before I jump into the market structure, I will go ahead and actually uh, go through the homework that I gave. But more importantly, give you guys a chance to learn it. So I will not give you everything, but I will share enough to give you a clue on how to handle the homework. So the homework 3, let me just confirm. Okay? Homework 3. Okay. You are to set up trades. Okay, homework 3 or homework 4? Okay, homework 3. Okay, the homework says 10 trades each 2 pips and 10 separate trades each 5 pips using 5-minute time frame. So let me just go ahead and do that here. Okay. Oops, sorry. Okay, so I will open. Okay. So here we are. And like I said earlier, a lot of your homework will follow the same pattern that I shared with you before, which is to take trades. And you'll be taking trades given certain parameters. So I mentioned that the first thing you do is you go first and set up your take profit, your profit target. So your profit target in this case um, was 10. Okay. Yes. No, 2 pips. Homework number 3. Sorry, homework number 3. So you come here first and then you go and set 2 pips. You come to your quick trades. Okay. And then single click, make sure that's checked. And then you check on this and you change it to 2 pips. All right. So you don't care so much about this, but you can just leave it like that. Our important point is to have this as 2 pips. And then you click apply. So what will this do? This will ensure that all your trades will be 2 pips, okay, which is the assignment. Once you've done that, then you come here, and I mentioned here the first thing you do, you make sure that this is lot size 0.01. So once we're here, then we ask ourselves, is the market going up or down? Okay. The best way of knowing that is by zooming out. So you zoom out like that, and you can see clearly the market seems to be going down. Okay. It has gone up, it's consolidating. Chances are it will continue going down. So what do? We enter our trades. Now, the homework says take 10 trades, each 2 pips. Please look at the position which says 0. Okay, but now you want 10 trades. So I come here and I click on sell because the market is going down. And I'll do it 10 times. So that's the first one. Okay, as you can see, that line there is your take profit. But you want it 10 times. That's 2. And you click 10 times and you're pretty much done there. I think I took too many. So I'm gonna kill some of them to meet the requirement of the trade. Okay. I did so many. And yes, they're already taking profit. So what you do is you kill some of them, or rather, what I want is 10. So I'm going to remove some of this. I want 10 trades. So I am removing. Okay, now we have 19, 18, 17. Okay, there. So what will happen is you let these trades run because you know the market is going to come down. Chances are all these things will become green and the market will take profit. All right. So that's the 10 trades of 2 pips each. I don't want to see 1.7, 1.5. No, 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 no. I want it to be precise. Okay. This is Forex and we have to be very, very precise. So then the other assignment, the second part of homework 3 is 5 minutes on the 5-minute time frame, 10 trades each of 5 pips. So you come back here and you change this from 1 minute to 5 minutes. Okay, while those other trades are going, that's fine. Okay, and now I want to change it. I want 5 pips. So I come here, change that to quick trades, and we want 5 pips. So I change this to 5. There, and then I do apply. Now, if you do this, you set up your trades, and the market is volatile enough, you'll probably get all your profit, or rather, you'll hit your profits within a very short time. So then what do? I then come here and take my trades. Okay, I need to take 10. So this number will have to go to 20. So I go, we're still going down. So I'm going to do a sell. So 1, 2. But this time, note that if you click on your take profit, it says 5 pips. Okay, 5 pips. That's what we want, which is the equivalent of $0.5. But you need to do 10. So we've done 2 so far. So I'll do it until it reaches 20. That's 3, 4, 5, 6, 7, 8, 9, 10. There. That's it. That's the homework. You have 10 trades, 5 pips. You have 10 trades, 2 pips. Okay. When they take profit, okay, hopefully I'll leave it running for a while. But when they take profit, your profits will be clean. They'll be clean 2.0 pips, 2.0 pips, and so on. Okay. In fact, I think some are already taking profit right now as we speak. They will not be like 1.5, 1 point something. No, no, no. They'll be clean 2 profits. Okay. Clean 2 pips profit. All right. I'll show you when that happens. Okay. I think I may have deleted some trades here. I think 5. Let me just add 5 more. 1, 2, 3, 4. Okay. All right. So then we'll go back to the class and then we'll come back and check those trades, how they're doing. Okay. Back to the class. Okay. We were talking of the market structure. And so in the market structure, we wanted to look at, we looked at the price cycle, what the price cycle is. Yeah. And so I will go back to that point and see if I can re-emphasize the importance of the market cycle. So I mentioned to you that when you are studying Forex, the most important thing is to know this thing we are calling price cycle, okay, where this is the ups and these are the lows, okay? And we said that the top is called resistance point, okay? And the bottom is called support. So when the markets move from resistance to support and support to resistance, okay, we call that the price cycle. So the price cycle can start from there. It goes down and then up and then down and then up, okay? So for us in particular, we shall be concerned with the distance from there to up there, okay? This is where we shall be learning. We shall be learning about what happens between the price cycle, between the price high and the price low. Okay, why? Because that is our price cycle. Okay, now when price moves from a low to a high, there are things we expect to happen. Okay, what we expect to happen is okay, so if the market is going like that, then down, and then up, and then down, and then up, and then down, okay, when the market is going, we call this a high. Okay, this is a high. Okay, and this is a low. Okay, so this is high and this is a low. Now, this here, it's a high, but it's not as high as the other one. So it's a low high. It's a lower high. Okay, and then this is low. Then this is lower than that. So this is a lower low. Okay, and then this one again is a low, but it's not as high as the other one. So it's actually a lower high. And this one is a lower low. So whenever you see the markets moving from a high to a low, then to a lower high, then to a lower low, okay, it's lower low because this one now is lower than this one, okay, and this high is lower than that one, okay, and we keep going down, we have another lower low. We call this a trend, a downtrend. So the definition of a downtrend is when the markets forms a pattern. It moves from periods of high to a lower high, and then low to a lower low. Okay, low to a lower low. Then we say the market is on a downtrend. Okay, if it was the opposite, going up, we would say the market is on an uptrend. So let's erase that. So this is low. Okay. Now, if the market was going up, okay, so like that, and then there, and then up there, then there, up there, then there. Okay. Now, here, if this is a high, okay, and this is a low, well, this is a higher high. Why? Because at this point, it is higher than the other. And this one is a higher low. And this is a higher high. And this is a higher low. Exactly the opposite of what we just saw earlier. So what do we mean by higher high? It means that here, if you measure this, okay, this is there. Now this one is higher, and that is even higher. So it's a higher high, okay? And the lows are, this is a low, this is a higher low, this is a higher low. So when the market moves from periods of high to a higher high, okay, and simultaneously from low to a higher low, we say the market is trending. It is on an uptrend. Okay. Now, it's very, very important for you to remember the uptrend and the downtrend. Okay. Most traders like to trade only when the market is going up and down. Okay. Uptrend. So we've learned uptrend, we've learned downtrend. Then the last one, or the other important one to note, is what we call consolidating. So the market moves in periods of highs and lows, but then sometimes it's neither moving up nor is it moving down. Okay, so the market might go like that. Okay, when the market does this, then we say that the market is consolidating. Why? Because it seems to be moving up and down between certain price level. Okay, remember this side is price and this side is time. Okay, so this is price and this is time. So as time is going, the market doesn't seem to be able to break certain levels. Okay, we say that the market is consolidating. So the word is consolidation, consolidating. Now, for many of you who are young and adventurous, you may have played with springs or rubber bands and so on and so on. Okay. The interesting thing when you used to play with the rubber bands, if you tie your rubber band, tie it somewhere, it's like a coil. Okay. But when it opens up with a very high momentum. So similarly, the markets do that. Okay. When they open up, okay, we call it a breakout. So this one can break out down here, but they break out with a very high momentum. Okay, so it can break down, or it could even come and break up here. It might go like that, come back, and then now go all the way up. Okay. Now, the important thing here is consolidation. So we've shared three things about the market structure. That the market, one, can go up and down in an uptrend. Okay. Two, you can go down and up in a downtrend. And three, it can consolidate. So those are the three important phases that the market goes through. So the market goes in phases. Okay. So at any given time, the market would probably be going like that. Okay. And then it goes up and then slows down and then goes down again. Okay. And then up, consolidation, and then up and so on. So this is not perfect, but as you can see, it goes in different steps. Okay. So we can say here the market was consolidating. We can say here the market was trending up. We can say here the market was consolidating. We can say here the market was trending down. We can say here the market was consolidating. We can say here the market is trending down. So many people like to only trade the trends. Okay. They don't like the consolidation, but of course you can understand why. Okay. You can understand why. Because the trend is easier. It's up and down, up and down, up and down. Okay, and this one down, up, down, up, down, up. And remember, we take profit when the markets are moving up and down. But when the market is consolidating, it takes a little more skill to trade it. Okay, so three things: market goes up, uptrend; market goes between two levels, that's consolidation, and then market goes down. All right. So those are the three main things that I wanted to share with you today, so that even as we continue practicing our trades, we know about the market structure. We know that the market trends or consolidates, okay? Trends up or down or consolidates, all right? Now, when we revisit our initial discussion, okay, about the markets, okay? Remember we had said that, okay, the markets go something like that, and then, okay, and then up, and then down. Okay, remember I'd said that there's what we call the price cycle, from a low to a high. Going forward, we shall learn how to read the map, how to read the charts, so that when the markets begin down there, you can almost say, okay, the market is in consolidation phase. Okay, and because it was at a support, okay, it is trying to go up to the resistance up on the top. So its journey to the top, which is support, no, sorry, resistance, along its journey, it will form some structures. The structure it will form must be in alignment, okay, with the way the market is structured. So we know that it will go up. As it goes up, if it consolidates around the middle part here, okay, it only has two options now. It can either continue going up or it can come back down, which means we shall be looking for a particular pattern, and that pattern is called a continuation pattern. Continuation. Okay, so that'll be the first option. That means it will continue going up, or it might come down. In that case, it might form what we call a reversal pattern. Reversal pattern. Okay, reversal pattern. So it's very, very important to note these formations, either the continuation or reversal pattern somewhere in the middle between support and resistance. Okay, we know that if the market reaches at the top, at the resistance point, there, it has options. Now it will consolidate. Once it's done consolidating, it can continue up, which means it will be a continuation or a breakout, or it might reverse, hence form another reversal pattern. Okay, so that might be too much for today, but for now, for today, this is what I wanted to share with you. Okay, so now when you get time, you can go back and Google or go to babypips.com. Okay, babypips.com, and you can supplement what we are doing here with the material you find here. It's Baby Pips. Okay, pips.com. Okay, you'll find that maybe we go to a little more depth than is necessary. Okay, then I'll also avoid a lot of unnecessary garbage. I will just give you what you need. Okay, so we've been having the class has been running for 30 minutes, and I don't intend to make it any longer than this. So this is your class for today. You'll have, of course, you have the recording by now. At the time of you watching this, you have the recording ready. Let me know if you have any questions. Otherwise, have a good day. And like I said, we'll have class on Friday. Okay, talk to you then. Thank you. Bye.